Thank you very much, Sean. Happy Saturday, everyone. I hope you had a wonderful week and welcome to our weekly market analysis for July 17th. So it was an interesting week last week. What happened, the markets doing their own thing. And then Thursday and Friday happened. We had Chairman Powell speaking to the Congress, and there was a hearing, and we also had the retail numbers, the CPI numbers, and then the consumer sentiment. So with that in mind, what we're going to do, as always, we're going to look at what the economy is doing, how is it doing, and review its effect on the markets. And we also obviously going to review the stock markets and other markets, commodity markets. Hopefully, we have a few interesting lessons that you can take advantage of learning from it. And as always, we will have the ETF and the stock of the week and the trade of the week. And also, we have our screening. So, with that in mind, let's look at our what happened last week. Number one, as always, I like to look at this under the hood, I call economic information. Now, one thing has happened in last 2 weeks that I think it has become a changing catalyst is obviously the variant, and it's like almost third or fourth wave, and that's affecting things, and it's affecting actually the public. I know, for instance, in California, in Los Angeles, they actually today, starting today, they have started the mandatory wearing masks again. Now we look at Sydney, Melbourne, in Australia. They have started, really locking down. Malaysia has like the worst case they've had. It's the worst case in Southeast Asia. So it has become a warning signal again. And there are a lot of states in the United States that they're getting affected. And obviously, not all the states have had that mandated vaccination. So you've got the tales of two really um, not economies, but like the vaccination stories. So that's affecting people's psychology, I think. And although some places are doing really well and they're opening, on the other hand, there is some warning signs out there. And I think that's affecting the markets as well. And we will review some of the information that came out. And the reason I said all this is because a lot of these numbers are before really strength of that variant wave. So I would be really interested again looking at, is it going to affect the traveling that much? Is it going to affect the hotels or the movies? And that's the reason I like to watch these numbers. As you can see, the trend has been um, pretty up with from the box office, the hotels, the flights, and that's what we look at month over month. So basically, on the other hand, you can see the weekly. It was beginning of July. It was lower, but then with the Black Widow, I think that has changed. Um, and that's the reason I like to look at these charts and see the blue line. That's my main concern compared to actually the gray line, which was 2019. And you can see there's been a lot of strength building. So we want to see whether this momentum gonna continue or is it gonna slow down. So again, why did I bring the variant? Well, what happened with the markets last week? What were again, we had Chairman Powell was very adamant. He's very dovish. So what the market is hearing from Chairman Powell is they're going to um, implement every tool that they have. They still think they're going to continue with the easy monetary policy, and that's what they're going to continue with. Now, the question is this time when he came out, like Thursday and Friday, the markets did not um, basically behave as far as favorably. So that's the interesting thing, and we're gonna I'm gonna review that in more details. as I have said it before, we really want to understand the fixed income side of things. How does the 30-year bond behaving? How is the 10-year notes behaving? And 2 and 5-year um, notes have been behaving defensively. So we want to understand that. So one of the things was it was really interesting that on Friday the retail sales came actually much stronger than anticipated. So the markets initially acted favorably, which was important. That was, and also we see the inventories were the sales, but also the inventories were more attractive. But what the markets took in part was the consumer sentiment, and it was worse than was expected. And it seems like the consumer is like a few things that are concerned. Number one, when you go shopping, it kind of is almost hitting the pocketbook now. Before, things were, again, the transitory people were, they have a lot of money in the savings, and they weren't looking at that much. But now that the price of food, and we look at the energy cost, the gasoline, the traveling, so that's it's affecting, I believe, from the sentiment point of view. But also, as I mentioned, I think that um, this not being 100% sure about this variant is bringing a little doubts. So I think that was one of the effects. So with that in mind, let's look at the sentiment of the market, what we have, where we stand. Again, this is the American Association of Individual Investors, July 14th, which is Wednesday. You can see there was a drop on the bullish side. So the market is really getting more of a neutral side. There's somewhere doldrums on top of everything else. So that's taken into consideration. And then you can see the bearish side grew a little bit. On the other hand, the fear and greed index, which is CNN, and that's more of internal. They look at, I've said it before, Maclellan oscillator put call ratio. So those numbers have become more cautious. So that's why now you're getting close to extreme fear. So that's one side of things. But on the other hand, you can see the market sentiment with Citigroup still pretty healthy, up at 122. So there's still optimism what's going to happen. This week, I wanted to introduce you to the Investors Intelligence Sentiment, which has been some of the oldest ones, actually, before all of the ones that we're sharing, except I think AII has been around for a while. But this one has been, and basically they look at the investor newsletters and the people who are in the business, and they see how bullish and how bearish they are, and what are their recommendations, and based on that, they come up with these numbers. So basically, this is as of July 13th, so it was a few days before Friday closing, and you can see what they have done. They look at the number of the percentage of the bulls compared to bears, and it's been, getting to the upper limits. We're at 4. So there's a lot of positiveness, and there's a lot of belief in the equity markets. When we separate them, you can see from the chart that the bulls are, close to the high of, 65 that had been highest in last. Goes back. Goes back to beginning of 87. So you can see where we have been, and these are, you can see the bears. So by itself, these are, there's been a lot of studies, and I have tons of them. I just don't want to bore you with them at this time, but we could have actually even the classes like 19 pages on this. It's not 100%, it could be a lagging indicator, but it just gives you some kind of a heads up just in case. You can see in, for instance, what happened in March of 2020. So there's extremes that we are looking at. And yet, right before that, there was some extreme, but not. So there was some warning sign, but not quite bad as far as when we're looking at, did we have warning sign in December of 2019, in February of 2020. So there was some, but it just, you want to look at again the ratio. And so when it's above the 3, usually that's a little warning sign. When it goes below 1, that's a magnificent time, maybe explore some of the extra the negativity in the market and start maybe accumulating. So, but that is called investor intelligence sentiment. So just a food for thought. So what happened in the market? So the market started okay on Monday, and then Thursday and Friday, especially Fridays, you know, things start turning around, and basically the Dow Jones Industrial was down 0.52%, and S&P was down about 1%, and Nasdaq was down about almost 2%. So the interesting thing was that Nasdaq and S&P again hit all-time high, and these mega caps, the FANG stocks, had been really carrying the markets in reality. So when we look at the segments of the market, the different indexes, everything was down except the utilities. So the utilities, we've said, there's two sides to it. Number one, they're a defensive sector of the market, so that makes sense. And then the other part is the interest rate side of the things, and it was more with the lower rates, they become more attractive. So that's where it was. The warning signs that I would suggest, and that's what I don't believe we still don't have selling signals in our market. So it's not like, you know, we have to short the market. There are just there is not the harmony. And I've seen the warning signs for the last few months, but it is kind of becoming more visible now in the sense that this transportation, which is a sign of healthy economy, has been not the kind of meandering, but also it has been just going sideways to down, and it started, it is all-time high in May, and since then, around that time, has been going down, and we had another bad week again in transportation, and then our small caps and Russell 2000, that was a huge drop for the week. It's down 5%. So that's more of a reflation story. What is happening? You know, is anything happening with the idea of expansion of the economy? All these economic sensitive stocks, smaller stocks, energy related, financial related, industrial related, what is happening to them? And you can see so many negatives. And then you can see that the S&P was 0.97 and the Dow Jones was 0.52. Those are the bigger stocks, but everything else was actually down. And also in the breadth of the market, advanced declining was like 1 to 3. So that's also telling us something's happening under the hood. And the dollar was up a little up. And again, this dollar story is because all the central banks are in cahoots, so it's not independent of what's going on around. So the strength of the dollar doesn't mean completely the health of the dollar. The T-bonds had a good week, and we will talk quite more about the bonds and the fixed income. Now, the crude oil, again, for many reasons, including the demand side, again, this variant, and also the energy stocks that you talk about, the supply, but there's this concern, again, about the variant as well, but also there was technical reason. So it's down to 71.81. Again, that $70 is a very sweet spot for the market, so we can see if that we will go below 70 or not, but at $75 became a resistance for short term now. Inflation was up a little bit, and you can see the gold was kind of flat for the past week. So looking at the charts, really nothing major in a sense that there's a lot of damage done. There isn't. We broke below you can see Thursday and Friday. We basically broke below our 8 exponential moving average, but we are right above the 21 day. So If we find the support there, then the market is ready to turn around and go back up. If not, then the next natural place would be the 50-day moving average. So it has been the best support in the recent memory. So you can see this happen. Now, as I mentioned, problem we will see in the next charts is it's like there's this separation, and we want to see the strength on all segments of the market, and it is kind of could be concerning. I've said it before, July historically is a strong month. August is not, so that's something we want to look at. I also look at this distribution days. You can see are much stronger than the accumulation days, so there's also a food for thought. Um, as you can see, the S&P 500 went down right on this 18-day moving average. The only thing is on the daily, now we are overbought from the stochastic momentum. The MACD is trying to cross. So from the daily point of view, it feels like it's a short-term, some type of a correction. On the weekly side, still we are embedded, so there's not a lot of damage is done on a weekly side. So which I put emphasis in the long term, we want to look at weekly. But on a daily, we just turned overbought. So basically, and remember, this is after S&P hit all-time high last week, and then NASDAQ hit the all-time high. NASDAQ is the same story. We are right on an 18-day moving average. The volatility is dropping, but also NASDAQ has become overbought. MACD has gone down as far as momentum has just crossed. I mean, one day doesn't give us enough information. That's why Monday is going to be important. But NASDAQ also on a weekly, still embedded on a weekly. So we still don't have any sell signal. On the other hand, look at what is happening with the Russell 2000. I mean, since we hit the upper Bollinger Band, and as you could see, we were overbought because we didn't become embedded. And every time we are overbought, once we hit the upper Bollinger Band, we want to go kiss the 18-day moving average, and we cannot hold, we drop, then we want to go hit the lower Bollinger Band or whatever the nearest moving average, in this case the 100-day, we hit that, the Bollinger Band, and now the Bollinger Bands are expanding. Now, we are oversold, but if we stay a couple of more days, then it's going to become embedded, so that means more weakness is coming on the Russell. One of the things is you will see in the next chart, again with the Russell, you will see there's a big component is obviously economic sensitive. It's the energy sector as well as some financial smaller stocks, but it's the financial sector. So that might explain what's going on. That's why I want to look at the weekly. You see on a weekly, we were overbought, and now we are getting to momentum is going down. We just hit the lower edge of the Bollinger Band, but the question is this going to expand, or are we still going to continue? We've been in this low volatility for a few weeks. So, but you see the MACD has turned down and momentum has turned down. So I would watch Russell. And the Dow Jones Industrial has just Friday, it's still too soon, just went to overbought. MACD still above zero and also hasn't crossed. So we watched the Dow Jones to see if that's going to turn down or is it going to turn around and go back up. This is, I've not looked into this a lot, but again, this transportation has concerned me since May. You can see we hit the all-time high in May, and then since then, it has been going down. We went all the way down to 100-day moving average. We tried to stay on that 100-day moving average. The momentum tried, but we just couldn't hold it. And we have broken below 100-day, we are below 18-day. We are touching the lower edge of Bollinger Band, but this concerns me. So it's just a food for thought. again, it has been a big move on these transportations, which are, again, they're heart of the economy. We talk about railroads, we talk about trucking companies, airlines, like, and then shipping companies, the FedEx and UPS of the world. So with all that in mind, one thing I want to share with is the XLU, the utility. I just want to show you with all the things, you see that the utilities have gone completely the opposite. They've been above the 100-day, they broke above 18-day, their volatility is expanding, they have become embedded, the MACD just crossed, and they went to the positive, the momentum is going up, the trend is trying to go up. So basically, utilities are telling us that maybe lower interest rates are here and the markets are a little extended, so the money is going there. We have hit the second part of the Bollinger Band, so we want to be concerned with that we might need a little correction, but that still doesn't mean that the momentum has changed and might continue. So that doesn't bode well for the markets. The other thing is the VIX. You see the VIX had a good day. We still not completely expanded. So we are under the 100-day, granted, but we have been holding to that 18-day moving average. Momentum is trying to go up and MACD is trying to cross. So we will discuss this a little further, the lesson of the week. And the other side is this volatility of VIX, and that tells us that again, VIX was actually lower than what it was before March of 2020, but the volatility of VIX is still pretty healthy. We've had that 110 number, and we're still expanding. So that means that there's still much concern with the future of the markets themselves. And we had talked about skew in the past, how high it was. So the hedge fund managers have been paying a lot of premium to make sure they can hedge themselves against a big downturn. Now, what is happening with 10-year note? And again, on the lesson of the week, I'm going to dive in a little more. But this tells you we broke below, this was in May, and we broke below the 18-day moving average. And since then, we've gone below the 100-day moving average. And we were like over 1.71, and everybody was like Goldman Sachs, oh, we're going to hit the 2 at no time. And here we are. So what is happening? Why the rates are down? Same thing with the 10-year note. We have broken above the 18-day. Now the momentum is we're overbought, but it's trying to go back up. And we did go outside the Bollinger Band. I think last week we talked about it. And guess what? We came back in. We almost touched the 18-day, and then we turned around. So that momentum continues. The bands are expanding. That was the U.S. bonds, and the 10-year notes. Sorry, that was the 10-year. This is the weekly I want to show. So the weekly, you can see the Bollinger Bands have narrowed, and basically the weekly is trying to expand. We are above the 18 weeks moving average, and we are above the 100-day moving average, 100 week. We were below that for longest time, so we have broken above that. So what is market telling us? Although we have just hit the Bollinger Band on a weekly basis, but markets are telling us there is some strength in understanding the lower rates, and will this continue? Is the market telling us something? Same thing on the 30-year bonds. You can see we are above 18-day moving average. We had broken above the 100-day moving average. MACD is up. The momentum is changing, although we are overbought, but it seems like, shortly we hit the upper Bollinger Band, came back, but Bollinger Band is still trying to expand. Last week, when we were speaking, we were outside, and I mentioned we're going to come inside, and we did. And we were overbought. We came and we hit 18-day, and guess what? We just bounced from that 18-day. one concern is, and I said it last week, is the only thing is for the 30-year bond really has that 100-week moving average, which we need to break above that. So we trying last 2 weeks to go above that. So once we do, on the way back, it didn't take that much. So we did break below that. So now it's trying to break above that. We are overbought, but let's see if we're going to be embedded and MACD is up. Again, you can see the Bollinger Band. We've been outside that for 2 days, so for 2 weeks, I mean. So that's one little thing as far as the resistance. But again, the bonds are telling us something. The financials, they had the big earnings last 2 weeks. They've been haven't gone anywhere. They were down Friday with the rates dropping. The financials drop, and this is the $60,000 question. We talked about NASDAQ. We talked about the big caps. They're holding the market up. The big Googles of the world, they are holding it up. But what happens if the financials, which have been holding themselves, although we're down, we go back all the way for 3 months or so, you see we are almost in a similar place. If that breaks down, that's going to affect quite a bit of things, including the S&P. So lower rates, not so good for financials. So what's going to happen? And that's what we will, again, watch the 10-year notes, the 30-year bonds, see what they have to say. The dollar has been, again, despite the fact that the rates have been going down, which is historic, it's not good for the dollar when the interest rates are down, but the relative rates still attractive. So the dollar is doing well. It's more of a sanctuary for the value, so it's trying to hold it. And again, comparing to Europe, but again the variant and what is happening in Europe, we comparing it to basically Aussie dollar. We're looking at British pound. So what is happening, that's trying to keep its strength and saying that, with all the things going on, that's the safest place to be. And although, again, the dollar's strong, you can see again, Friday, the gold retraced, but gold has kept its value. Obviously, the lower the rate, and the less of a concern about the increasing interest rates, that bodes well for non-interest, non-dividend paying investments like gold. Okay. Next, we have the silver, which has been, I've mentioned it to, I've mentioned that the silver is very much related to gold, but also silver has the economic component of it. So it's a 50-50, so it's almost a marriage of gold and copper. So this is something that we want to be concerned with, that even though long-term I'm still positive, that's one of the reasons it has been behaving weaker than gold, and we've been sitting under the 100-day moving average. The volatility has really collapsed. And again, if I show you the next chart, which is the copper, and then I go back, let's say we see the gold has had a nice movement up, but silver has been completely flat. And this is copper, which has been very flat. Look at the volatility. So again, copper, we've talked about this in the past. It's a lot dependent on what is the Chinese policy going to be. So basically with the China, with the trying to cool down the commodities, and also they want to see, we were looking at what is the demand for the infrastructure in China. So they are between 50 and 60% user of the copper. But one of the catalysts for the copper was obviously elections in Bolivia, and concerns about Peru, whether they're going to nationalize their miners or not. And And so, but this is more of, in my opinion, is more of the economic demand. So the reason, again, you can see, you look at this chart, you look at silver, and you look at gold. So there's this connection. So next, again, I can then go, we talk about dollar. There's still concern that, would Bitcoin take over and become another currency? So there's a competition with gold. So is this a Elon Musk story? We don't know, but again, there's the volatility just kept collapsing. It was another, down week for the Bitcoin, and it is lower Bollinger Band, and just the volatility just really collapsing. So just give you some ideas if you want to play Bitcoin. This is we need some directions, but right now it hasn't been the best investments to be in, obviously. So we are getting to the oversold, and let's see what happens. We will watch this. It seems like a lot of option players and things like they look at the 20,000 as a natural, attractive valuation to get in. So we'll see what happens. Crude oil, again, with the variant and other things. So we broke below the 18-day, and we had been a little overbought, and the momentum is going down, the MACD is going down. So which has in turn has really affected the energy sector, and we went below the 100-day moving average. So, and that's one of the reasons I want to watch the energy, because that's affecting the Russell 2000 again, including the industrials. Last but not least, I think this subject came out, and it was the Adobe, and talking about historically the markets do not like to stay outside the Bollinger Bands more than 5 bars, and the reason is again statistically. So you can see Adobe was up 1, 2, 3, 4 weeks, and then the 5th week it came inside. That doesn't mean it has to go down. It's just the Bollinger Bands, they kind of converge. Now, one of the things you have to also remember, when you see that the bars are hugging the upper bands or lower bands, that's shown of the strength or the momentum. We call these railroad tracks. So that tells you that this is healthy. And even though this is going to come down, and inside, might see that the Bollinger Band, at least, again, it's going to expand. And with that, the prices, this is on a weekly, can continue going up. So the Bollinger Bands can expand, and then the prices will expand with it. So just being outside the Bollinger Band, or just being, close to Bollinger, that doesn't mean the market is going to go down, or it's like you got to short it. It just tells you that it cannot stay outside this Bollinger Band. So either Bollinger Band is going to catch up with it, or is it going to come inside? So that happened here. So again, the news was like it couldn't be outside of it for more than 5 weeks, or this case was 4. The 5th one, you can see we came. All right. Oh, expected moves. This is very interesting. We talked in the last few weeks. I mentioned to you, it's been a little difficult for the option market makers. They do not like when things violate the boundaries are expected move. And past few weeks, different markets have gone outside, and that showed us the concerns with the markets. There's this efficiencies kind of it's becoming a little inefficient. So it's being questioned. So this week, though, you can see we went on Friday. So for the first 3 days, we were right within the range. And what happened on Friday, we went very close to the lower edge of our expected move. So these expected moves work, and most of the time, but when we violate them, then it warns us about upcoming, something is cooking. So we did hit all-time high, and then this week, last week, I think we were like at $62 expected move. This week will be about $72, $73. So we are expanding our expected move. NASDAQ, the same thing. NASDAQ went and then was at its expected move, but stayed within the expected move and went below the opening. We hit the all-time high. As soon as it hit the all-time high, it has been selling, but stayed within its range. On the other hand, this is a story with Russell 2000. So let's go back for a few weeks. Nothing has happened for a few months, but we almost went to second standard deviation on IWM outside the week before, outside. The week before, we just barely stayed. The week before that, outside. The previous week, outside, outside. So with IWM, we've had these warnings outside. So it has been pretty violent, but yet, there's not on a weekly basis, you see nothing has happened. So it tells us that there's, again, something has happened under the hood with IWM. And this is a transportation. I want to share that with you, that we did go outside this edge, on the lower edge. The previous week, we did go way outside and came back and closed right inside. So that's, again, it tells us the inefficiency, what's going on. The TLT, or the bond ETF, we closed right on the upper edge, but the weeks before we had closed above, and then we were below and above. So there's been a lot of violations of those. And the financials finished right on the lower edge of the Bollinger Band, and they had been violating it. XLF went 2 standard deviation. I mean, XLE, the energy weight, you can see again, they've been violating it. And the gold hit the upper edge and closed down Friday. And silver went to the lower edge of the Bollinger Band. I mean, the expected move. Okay. All right, there's a few lessons I'd like to share with you. Let me start with the first one, is about the bonds. So why these bonds are rallying? Didn't we talk about inflation? Isn't that fear that people think there's going to be, everything is going to go up? And as you know, the inflation is not good for bonds. And why is that? Because the bonds are, you are receiving an interest rate based on the future. So if I think the inflation is going to be higher 10 years down the road, 30 years down the road, 5 years down the road, I expect a premium for that. So if you're paying me 1% and inflation is going to be 2%, I'm actually losing 1%. Why should I lend you my money? So when inflation is a big concern, then you have to expect more higher rates. On the other hand, so if this is not the case, if they're, so we up to just a couple of weeks ago, we were all talking about how bad the inflation is going to be and this and that. So why the rates are going down? So I have 3 theories, and maybe there are more. But number one, it could be that there's just so much money sitting in money markets and other things that it has to be put in use. So the money, you can put so much into equity, so the money has to be diversified. So it could be at the supply and demand side. So allocation, asset allocation, so the money is coming to the bond funds. That's one idea. The second thing is maybe people are now concerned that the equity markets are becoming expensive. So let's take the money and put it in something more defensive. The third idea, this is what concerns me, and that's what it tells us, something that maybe the bond market knows that we don't know. Is this after listening to Chairman Powell and him being so dovish and saying that, listen, we are going to keep the rates down? Is that telling us that actually economy is slowing down? Now, if economy slows down, then obviously that's what I talked about, the reflation. All these companies that they were counting on the stronger growth, we talked about the GDP, how fast it's going to grow, how that's going to be affected. And is that the reason that IWM or the Russell 2000 is being affected? Transportation is being down. So I never forget when it was the first week of March when Chairman Powell, and I think we had a class on it, was like one of our first classes we were doing, and I was looking at what the futures market, we're looking at the rate increases for the future, and a lot of them were counting on 0.25 and 0.5% as far as the rates going down. They were thinking of, in order to stimulate the economy, the news with the COVID had just come out. And then Chairman Powell came in and he said, we're going to drop the rates by 1%. And the markets really got shaken up. So on one hand, we welcome much lower rates, right? So it's like really good. I mean, the stock market loves it when interest rates go down, drop so much. On the other hand, the markets, if you recall what happened in March of last year, we were having limit downs and the markets were just selling up every day, huge volatility. And there was a big drop after the Chairman Powell came out with this big surprise. So what did markets say? The market said, does he know something that we don't know? Is this COVID thing is much worse than that we thought? So are they being proactive? And I think the same idea is now. What the Fed's seeing that maybe the markets have not been seeing, and that's why the idea is maybe there is a slower growth anticipation and consequently lower concern about the inflation in the sense of the growth. So basically, these are some of the theories that I have, and I think for the notes and bonds, maybe that's one of the reasons. So I want to share this with you to see, the money market funds have been going down, and the money has been moving to equity funds, and look at what is happening with municipal bonds, but also look at the taxable bond funds. There has been $6.38 billion have moved from money markets to taxable bond funds. So the second lesson, I have more of a screening tool. Just again, every week, I like to give you some tools that you can actually do your own research, especially on weekends. And one of the things is relative strength, relative performance. We want to see what sectors are the strongest. And based on that, the top down, then we can look at what has been the strongest in the industry and then what's strongest in economy. So we are going from one layer to next layer to next layer, so kind of eliminate things. So one of the things I thought is every week I review the group, so sometimes you discuss it, which was the strongest sectors. And so all you have to do, again, I like this Finviz, it's free and it's easy to use. So this is something from today. So we go to the group. So as far as just to show you how we started. So what I wanted to see is I want to see what are the top relative performers in the sectors. So what we look at is the different sectors, and we want to see who are our heroes in a sense. So what are the strongest ones? So basically what I like to do is I like to look at the 4 different periods. I like to see on a 1 week relative performance, 1 month, 3 months, and 6 months. I haven't looked at a year, especially last year it's an anomaly. So we're comparing to, there's a lot of growth compared to what we had last year. So these are my 4 time periods that I look at. Based on that, what I'm looking for is I want to see a commonality, something in common, to see what sector really has been a hero. It's been in top 3 or top 4. I use top 4 for not only for like 6 months, but for 3 months, for 1 month, and for 1 week. So that momentum is continuing. So it's not just they were doing really good, like energy was doing excellent. Financials were doing good for the year to date, and then they've been fizzling out this past week. So look at energy. it's down 6.64%. Financials were down, 1.21%. So what I'm looking for is which ones are in the top 3 or 4. So based on this, I came up with the 2 sectors of the market which have been the strongest for year to date, kind of. So you can see the communication services has been healthy for the past 6 months, but also for 3 months has been number 2. For 1 month has been number 2 again. And this week it was barely flat. So basically that's something tells me that there's, there's some strength. Well, it was 0.87%. So I will take that into consideration, but also see that it's been in top 2 or 1 for the 3 periods. So that's one thing I look at. And then I noticed that real estate has been actually on top 3. It was flat for the weekly. It was number 4 for the monthly. It was number 1 for 3 months and number 2 for 6 months. So that's, of all the sectors that we've looked at, it seems like these are the 2 that they look strongest. And then I go to, so all you have to do is, let's say we choose the communication services. It's just an example, so all you have to do is just click on communication services, and it takes you to the industries that have been the top. You look at all the industries in communication services, and we do the same thing. We see that internet content and information was number 1 for half a year, number 1 for 3 months, number 1 for 1 month, and number 3 this week. So it's the momentum still strong, although we want to see what happened this week. We want to look at the things and come up with some ideas. So now that we did that, so it looks like internet content and information is a pretty strong industry. And now that we've narrowed to internet content, you just, again, click on that, and then basically it takes you for all the there's 69 companies in internet information and content. And basically you can, I did it by performance by month. So I want to see which ones are the strongest, like Sohu was, or I've been investing myself, like WB has been pretty strong. So then now it kind of narrows down from almost 7,800 stocks. You can narrow down to like 10 or 15 if you like. So it was just, again, some type of giving you ideas about screening and looking for strength if you're looking at the finding some candidates, some of your watch list. The next thing is, it was really interesting because we talk about the VIX and the volatility. So I thought, let's take a look at NASDAQ for this past almost a year now. And, obviously it's been doing wonderfully. You can, this is like 2 days, looks like a hiccup. I mean, are you aware you're almost at 15,000? And what happened was 1%, a drop of 1% is 150 points. So when you drop like 75 points or 8 points or 70, that's not even 0.5%. So basically, these look like a hiccup. But in order to get like 3% healthy correction, the market has to drop like 450 points. So what I was looking at is I noticed that I looked at the historical volatility, and this is the lowest we've been in the past year. So the volatility is very low compared to where we had been. Now, that doesn't mean that the markets are going to drop, it just tells you, as far as any ideas that you want to take advantage of, maybe this is something you look at to see. We look at the squeeze, we look at Bollinger Bands, and this is one of the other ones. You can see how low the historical volatility is, but yet implied volatility was the lowest, but now it's moving up. So the historical volatility has been going down, while the implied volatility has been actually started moving up. So I wanted to look at the relative to each other. So I want to see what is the relationship between implied volatility to historical volatility. And now I notice it's been the highest. So implied volatility, there's two things. Either the implied volatility is being too high compared to historical, or the historical volatility is too low and has to, now it's gonna start expanding. And what we'll see is with more volatility, then we will have a higher historical volatility. So just a little observation that with NASDAQ, how low the historical volatility has been. I want to introduce you to a term, if you're not familiar, it's called variable interest equity. And basically, to just narrow it down, is these are the special situation equity holding that there's a lot of times, let's say you were in Cayman Island, or there are places that you're not, some companies want to issue IPOs, or they want to do some research. So what they do, they come up with an investment idea. So you actually buy a company, but really don't have the ownership of that. And they call them like a special purpose vehicles. And there are reasons for that. But they are popular, especially with the foreign companies. And it is something that the owners do not have the right to, let's say, voting rights. So there's a reason I talk about this, is it's important for you to understand these, because in the last few weeks, for instance, like Didi, the Chinese Uber, has been in the news. And if you watched, it was an IPO not long ago, and you see the price have been going down. There's a China's play, the government rules. And the reason I want to connect those two is Didi was actually, it was a very special IPO. It's something that we don't see it in, let's say, United States. It was IPO with, when you own it, you don't have the ownership. Basically, Didi is using the variable interest equity from a Cayman Island. And so what they had to do is basically using a clause in as far as the financial securities rules in China, because the Chinese government doesn't allow the foreign ownership, they use something like variable interest equity. So what happens, they attract the capital from the foreign investors without them saying anything. And we will discuss this a little more. I have in our trading lesson, is that's what there's questions about what's happening in China. And I will look, and I know you've been holding, you know, if you're interested in Chinese equities, this is a big, it's been a big story in the last month or so at least. And we think about Alibaba, look at what has happened to all the stocks, interference of the government, what's going on. But I thought it's for you to understand what is, why it's important, because there's a lot of companies there that's being used this way. So the trade of the week, I'm going to make it very short. It was as far as the trading itself, if you're doing the gap play, you should have had a really nice week, because every day, I mean, you look at, this is on Tuesday, immediately we closed that gap. Wednesday, closed that gap. Now, it was interesting Thursday, again, with the testimony and other things, we closed half a gap, and we stayed within our first hour range till approximately about 10 o'clock, 11, we went to my next support, and then we came back and we closed again within our range. The interesting thing is the next day we came back, we almost closed the previous day's gap. And guess what, on Friday, which was, so our rules on gap plays, that's not the day that I play, and this would have been a great day to play actually. It was a Friday, and it was option monthly option expiration. So there's a 2 in hand, and guess what happened immediately? I mean, the whole gap just got filled quickly. The IW, the Russell 2000 also had a gap that got played. Russell had a nice also charting as far as the gap goes. And then we went to our previous days, again, the support that we've had. We struggle, and then toward the end of the day, we actually sold off. Which doesn't bode well. I don't like it when the Fridays we get the sell-offs, but anyway. So that was as far as the trading. So I hope you enjoyed that market, that gap plays. The ETF of the week. So this week, what I want to look at is, this is a really interesting, rather than just speaking about one ETF, I want to give you a list of, there's this company that looks at the ETF channel. They rank ETFs based on the brokerage's rating of its holdings. So I'll give you an example. Let's say you have one ETF that owns Amazon and Google and Shopify and so on, and they all are like on the list of the analysts and the recommendations. They are all like 4 or 5 stars. They're all on the buy side, and everybody loves them. So they don't rate the ETF themselves. They are looking at the underlying of the holdings. And if they have strong holdings, then based on that, they give them stars. So I just thought to share these top 10 funds. So it's not that FDNI is a great fund and it's been doing really well. No, it just says that the holdings that FDNI has is ranked very highly by brokerage firms. So I obviously have access to this, and you can see there's some common themes. You see China and China. You see that some international, this internet fund, which has quite a bit in Hong Kong. And then basically some technology and global tech, you can see, and then communication services. So didn't plan this, but you can see our ranking of the sectors and industries. All of a sudden we have internet and we have communication services. So I thought, let's talk about, since we talked about the communications and internet, let's see what is the largest internet fund, and that is FDN. And obviously, it kind of mimics what happened with NASDAQ, and we are in the upper channel. So it's something that maybe you can review if you feel the momentum will, if we come to that 21-day moving average, and it will turn around. Maybe it will take the internet fund with it. So it is, again, the largest fund. So here it is. They invest in the internet commerce and internet services. They're the oldest one, since 2006, and they're the largest one. It's like 10.8 billion. There's 3 other funds that you can invest basically, and expense ratio is pretty reasonable. So the holdings are internet services, software, department stores, IT services, and the biggest holdings are Amazon, Facebook, PayPal, Alphabet, Google, Netflix, and Zoom, and DocuSign. So, there's XWeb is another, large, another internet oriented that you could start compare, which is less expensive, although it's much smaller, but it has a higher holding. So I decided to go one step further. So we talk about, this is all in the United States. As you can see, all the holdings are American companies. So what if we looked at FDNI, which was ranked #1 based on the top 10? Now, this is ex-US funds, and they are internet, and we talk about online retail and commerce, publishing, gaming, and you can see the majority of it is Hong Kong. There's some, United States, which is kind of secondary, Netherlands, South Korea. So basically, this is countries, and then these are the companies that part of that. It's a small ETF is 127 million, and expense ratio is a little higher, which is understandable. It is part of the global. It's an international fund, so it's a little more expensive to manage. And then, but let's see the big difference, right? So that was a pure American. All the companies have done well. The reason I want to show you this is, if you're looking for opportunities for the future, perhaps, and if you get closer to where technically you think it could be attractive, you feel there's a potential. It's only 10,000 volume, but there's a lot of Chinese story, and because that's the theme I'm going with, by the way. So if I wasn't clear on that, so um, the China. So instead of talking about individual stocks today, I thought let's focus on China because there's probably over 280 or so Chinese companies. A lot has been happening in China recently, as you know, with the crackdown and everything. Now, can you find bargains? Is this a good time to get into Chinese equities? And what is happening with the Chinese government? What's going on? So let me just first start. What has happened in the past 12 years? I mean, I go back to 2000, I think it's like 2005. So it's 16 years. But I'm going to emphasize the last 12 years. So this is the height of the Chinese equities that happened in 2007. And this is what happened all the way, it happened 2009 collapse. So let's go back to 2008. So if you would have invested, so that was a little high. Basically what it tells us from 2008, and this is FXI, by the way, it's a large cap. You can use the whole other indexes, the A shares and other things. It's like a picture I just want to take, and you look at kind of a related story about what is happening in China. Basically, while this is, again, I'm going back to 2008 in the United States. This is where we were in S&P, and this is where we are now. We have tripled where we were in the height of 2008. So I'm not even talking about from the low of 2009, just to 2008. And it took us a few years, 2013, as you know, it took us 5 years to break even. But after that, we've just gone one way almost, although we had some corrections along the way, including last year. But if you were a holder of Chinese market for the last 12, 13 years, we have gone nowhere. So what is happening? Why this is happening here? And we hear so much about China and the opportunities, the second largest economy. So let's talk about the recent issues and what's going on with China and what is happening with um, uh, President Xi and what the government is doing. So one of the core issues, especially this happened, we started with Alibaba, but with Didi, because I mentioned the Didi. So it's about auditing powers, right? So I mentioned 280. That says, they have about 248 companies, and there's three indexes. It's over 2.1 trillion dollars, and that's the capitalization. So it's pretty large. Now, we know that SEC wanted to make sure they can be able to audit the Chinese and as a public company. That was it. Remember, there was a big discussion, and well, it didn't happen. So SEC said that's okay. Well, we're going to reject it. So because the China said, well, we'll do it, and SEC said no, thank you. So what is happening is, again, this auditing situation. So would you invest in a company that you are not able to look at their financials? So basically, that's a big problem right now. And what is happening with China, with the presidency, what China is doing in general, when you look at it, it almost looks like open market in the sense that they're saying that they're capitalistic, but they want to have control. In reality, and that's the reason I want to show with why and with Didi, in reality, nothing really has changed. The markets completely are controlled with the government. And basically, we look at the auditing and other things, they want to have the total control. but they also, it's a sweet spot because they like to have the foreign capital. So by using this special vehicle and, and basically with the variable interest equities kind of, these Ys. So what they do, they can bring, the companies can have the capital that they needed, but there's no voting rights. So government can control, the markets have to answer to that. So the problem will be in the future is that China is aging, aging populations, the demographics. So what I want to show you here is this is the demographics of the populations, and you see the male and the age group. And when we talk about pyramid, you want to have, the younger age, you want to have much larger than the aging population. So when you get to this area, you see that there is going to be a lot of need for the social programs, and there's not enough, especially with the one-child policy of like 70s, and that hasn't helped. So this is a question that China has to answer. Now, when we look at, just compare this to India, this is how it's supposed to be. You see such a young population, and they're going to be able to uh, basically uh, provide the support for the aging population. Now, Japan also has a very much aging population. So what is happening, there's always this question how the social programs are going to be um, uh, covering all the expenses. And it's kind of similar to China in a sense. You can see the young people are much less than actually the older generations, but Japan was a rich economy, and it is rich. China was not, just building. So that's the question. Now, on the positive side, let me just go back. What is happening with China? I think there's this comparison with the Cold War with the Russia, and I think we are completely different. I think one of the interesting things between the China and United States, and that's a food for thought I want you to think about, is both countries need each other. So if they're hostile, it's more of a from the global point of view, more political side of things could be, let's say with the Taiwan situation, for instance, or the sea, international seas situations. But other than that, they economically, it will work very much if they cooperate with each other. So although they want to dominate each other, but they still need each other. So they cannot destroy each other because each one needs. I mean, Russia and the United States, they could have destroyed each other, and that would have been not a problem, although they needed each other for the increasing the defense budget or whatever they were doing. But with China, I think economically we need each other. So, but the question is how much is President Xi and the predecessors, they all have the total power, and what's going to happen. And the reason I wanted to come up rather than just a stock of the week, just to open your ideas as far as there's so many companies listed in the United States. Is there any opportunity to perhaps invest in them? I mean, we talk about Alibaba's. I looked at Didi, it's like, but I want to give you a little information as far as like, again, go to the roots of the things in companies like Didi, see how much control you have as a shareholder and take it from there. So the question is, in the next 5 months, 10 months, things will change. Do you, if you feel positive that eventually that has to change, then maybe it's a good time to look at China. I just showed you last 12 years, the markets go through cycles. And again, for the decade of 20s, it's been, in my opinion, we are going to move from more of a United States investments, equities. I think internationally emerging markets, we probably be more successful if we met 2029. I believe that might be the time when we look back and say, well, yeah, the things have changed. And instead of S&P going 3 times up, emerging markets finally catching up, or maybe China. but I just want to share where we stand. So, but nothing stays the same all the time. It takes time, but we go through the cycles. All right. Sorry about a little long discussion on that, but I just want to give some ideas. Scan for squeeze this week, I made it kind of simple and sweet with the Dow Jones Industrial, with a lot of earnings coming up. There's some interesting squeezes developing with some large companies. So and these are from the setup point of view. So these are the about 8 companies, so worthwhile to look at them. Tons of, again, a lot of technology companies. Obviously, the big grandpa or big mega caps are going to be the following week, but we still we still got from the IBM and Netflix and Chipotle and Coca-Cola to Johnson and Johnson, ASML, CSX, looking at Snap, Intel, American Express. There's quite a few. Capital One. There's a lot coming up. So there's a lot to a very diversified group. And again, as always, take a look at basically find out some of the stocks that the implied volatility is much larger than their average move. So you want to see if there's any opportunity you could use. Again, I would encourage you to read this. If you get the slides, these are good to tell you what the projection is and has there been any unusual option activities in these stocks, from Netflix to AT&T, Coca-Cola, Intel, Johnson & Johnson, obviously American Airlines. So it's completely a very diverse group of stocks, IBM and Tractors Supply Company. Okay, very good. With that in mind, I very much appreciate your attention. Thank you very much. So we can stop recording and then open up for Q&A.